Hello? Hello, mic check. Hello? 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 So today we'll start with our next chapter, framework and presentation of financial statement. Framework for preparation and presentation of financial statement. Hey Gemini, let's learn. Today we are going to learn framework for preparation and presentation of financial statement, the second chapter of advanced accounting for C intermediate examination 2025. Let's start. So being is visible. Visible. Let's start. Okay. So here we have break down the aspects of financial framework. So we have break down the key aspect of this framework. We will cover purpose and status of the framework. Why do we even need a framework, for example? And then objective of the financial statement. What is the ultimate goal of preparing and presenting financial statement? Then we will see qualitative characteristics of financial statement such as comparability. What makes financial statement and financial information useful? Then we will see different elements of financial statements such as assets, liability, equity, revenue, and expenses. Those are the building blocks of financial statement. Then we are going to learn recognition and measurement requirements. When should an item be included in the financial statement and at what value? Then we will see the concept of capital and capital maintenance and different ways to define and measure capital. Let's start. Okay. Now we'll see the purpose of the framework. The framework serves several important purposes. First one is to assist the preparers of financial statement, to assist the auditor, to assist the user of financial statement, and to assist standard setting bodies. First one, to assist the preparers of financial statement, it helps them apply accounting standards and deal with issues not specifically covered by standard. Wait a second. Okay. Then it assists to the auditors. It helps auditors form an opinion on whether the financial statements comply with accounting standards or not. To assist the users of financial statements, it helps users understand the information contained in the financial statements prepared in accordance with accounting standards. Then to assist us standard setting bodies like ICAI in India, it helps them in developing and reviewing accounting standards, ensuring that new standards are consistent with existing ones and the fundamental concepts. It provides a basis for establishing future accounting standards to assist all parties in understanding and interpreting accounting standards. In essence, it creates a common understanding and theoretical basis for financial reporting and promoting consistency and clarity. Now, status of we will see status of the framework. This is a very important point to grasp. The framework is not an Indian accounting standard, India's, or an accounting standard, yes. It does not define standards for any particular measurement or disclosure issues. If there is a conflict between framework and an India's or ES, the requirements of the specific India's or ES will prevail. This is because India's or ES are specific rules for a particular transaction or event, while the framework provides general principles. So, uh, when we speak framework, it is in general in nature, whereas India's or ES are specific in nature. They target, they concentrate, or they focus on the particular transaction, particular kind of transaction or event. Hence, they always prevail over the framework. Think of the framework as a constitution and Indias and AS as the specific laws like provision. So the framework is general, broader, whereas ES, Indias are specific and narrower. Now, if a law contradicts the constitution, the law has to be followed in the context of financial reporting and the specific Indias and AS takes a precedence. Okay, now it provides a foundation for development of future accounting standards. Now, in summary, the framework is a guide, a conceptual map for financial reporting. It's not a rule book that overrides specific accounting standards, but rather a tool that helps in their creation and application. Do you have any questions? No. Let's start. Now we will see the objective of financial statements. This is arguably the most important part of the entire framework because it defines the ultimate goal of financial statement or financial reporting. If you understand why we are preparing financial statement, the how and what become much clearer. The primary objective of financial statements prepared under the framework is to provide financial information about the reporting entity that is useful to a wide range of users in making economic decisions. Let's break down the key phrases in this objective. First one, provide financial information about the reporting entity useful to a wide range of users in making economic decisions. First one is key phrases in this objective. We can see that first one is provide financial information. This is the core function. Financial statement communicate quantitative information. Or which kind of information? Quantitative, not a qualitative. Financial statement communicate quantitative information, primarily in monetary terms, about an entity's financial position, performance, and cash flows, about the reporting entity. The second keyword or key phrase is about the reporting entity. The information relates specifically to a particular business or an organization, such as Reliance Industry Limited or a local shop or a non-profit organization. The financial statement are prepared for that entity only, useful to a wide range of users. Who are these users? Investor to decide whether to buy, hold, or sell equity or debt instrument. They are interested in assessing the company's ability to generate returns, revenues. Lenders, second one is lenders and other creditors to decide whether to grant loan extend credit, or collect existing debts. They are interested in companies' ability to repay its obligation. So investors are interested in its ability to generate returns, whereas lenders are interested in companies' ability to pay their obligations. Its obligation management. While primarily internal users, they also use financial statements for decision making, planning, and control. Then fourth one is suppliers and other trade creditors to assess whether the amounts owing to them will be paid when due. Customers to assess the continuance of entity, especially when they have a long-term involvement with or are dependent on the entity. Government and their agency to regulate government and their agency and to regulate the activities of entities and determine taxation policies and for national income statistic public to assess the impact of the entity on the economy, local environment and employment, etc. In making economic decisions, this is ultimate purpose. Users make decisions such as whether to invest in the entity, whether to lend money to the entity, whether to continue doing business with it, with the entity, whether the entity is creditworthy, assessing management's stewardship, etc. To be useful for decision making, the financial statement should provide information about the entity's financial position and entity's financial performance. Entity's financial position, this is a primary shown in the statement of profit and loss or income statement, which represents in the financial performance shown in the statement of profit and loss or income statement, which present income and expense over a period, whereas an entity's financial position, which is primarily shown in the balance sheet or statement of financial position, which presents assets, liabilities, and equity at a specific point in time. So here two key phrases are there. The financial position is at a specific point in time, whereas profit and loss is over a period. Statement is for over a period. Okay. Now the entity's cash flows. This is also in the cash flow statement, which represents the inflows and outflows of cash over a period, categorized into operating, investing, and financing activities. Okay. Do you have any issue? Yes. No. Now we will move on to the next important topic, that is qualitative characteristic of financial statement. The framework identifies the qualities that make financial information useful to users. These are often divided into two main categories. First one is fundamental qualitative characteristics, and the second one is enhancing qualitative characteristics. Fundamental qualitative characteristics. These are the most important characteristics that must be present for information to be useful. Without them, information is likely to be helpful. Enhancing qualitative characteristics. These characteristics improve the usefulness of information that is already relevant and faithfully represented. Let's start the fundamental qualitative characteristic. Fundamental qualitative characteristic. There are two fundamental qualitative characteristics. Those are relevance and faithful representation. Let's explore each in detail. Relevance. Financial information is relevant if it is capable of making difference in the economic decisions made by users. Information has relevance if it possesses predictive value and confirmatory value. Predictive value, it can be used as input to predict the future outcomes. For example, current sales trends might help predict future revenue, and confirmatory value, it provides feedback about confirms or changes prior evaluation. For example, actual sales figures confirm or refute earlier predictions about sales. Second one is, and about relevance, we discuss the term materiality. It is an important aspect of relevance. Information is material If omitting it or misstating it could influence decisions that users may on the basis of the financial information about a specific reporting entity. Materiality is entity specific, meaning meaning what materiality is entity specific, meaning what is material for one company might not be for the other another company. And it depends on the nature or magnitude or both of the items to which the information relates in the context of an individual entity's financial report. In simpler terms, relevant information helps users form expectation about the future and helps them see if their past expectations were correct. Then second one is faithful representation. Financial information is a faithful representation if it depicts the economic phenomena that it purports to depict. To be perfectly faithful representation, information would have three characteristics. First one, it should be complete, it should be neutral, and it should be free from error. First one is completeness. All necessary information for a user to understand the phenomena being depicted is included. This means providing description and explanation where needed, not just numbers. For example, if a company has, for example, if a company has a significant contingent liability, merely stating the amount isn't enough. The nature of the contingency should also be described. Neutrality. Information is presented without a bias in the selection of or presentation. It is not slanted or weighted or emphasized, de-emphasized, otherwise manipulated to achieve a predetermined result or influence user user behavior and its objective. There must be neutrality. It should be unbiased, free from error. There are no errors or omissions in the description of the phenomena, and the process used to produce the reported information has been selected and applied with no errors in the process, freedom from, let us say, okay, yeah, Now we will see neutrality. Information is presented without a bias in the selection or presentation. It is not slanted, weighted, or emphasized or de-emphasized or otherwise manipulated to achieve a predetermined result or influence user behavior. It's objective. Freedom from error. There are no errors or omissions in the description of the phenomena, and the process used to produce the reported information has been selected and applied with no errors in the process. Freedom from error does not mean perfect accuracy, as estimates are often involved. It means that the best available estimate have been used and are described as such. In similar terms, faithful representation means the financial statements truly reflect what they claim to reflect and without trying to paint an overly overlie positive and negative picture. It's about honesty and accuracy. Relationship between relevance and faithful representation. Both characteristics are crucial. Relevant information that is not faithfully represented is misleading. Faithfully represented information that is not relevant is useless. The aim is to maximize both relevance and faithful representation. Now, the aim is to maximize both, and but sometimes a balance is needed, as achieving one perfectly might compromise the other. Do you have any question about relevance and fair full presentation, including predictive or confirmatory value, vitality, completeness, neutrality, freedom from error? No, thank you. Let's proceed. Now we will see the. What is it? Let's proceed. Our fourth topic, that is
Understood. Having covered the fundamental qualitative
the second type
characteristics,
when we
relevance, and
have
faithful
done with.
representation, let's now move on to the asterisk enhancing qualitative characteristics. B. And
So we have done with the fundamental qualitative characteristics. Now we will start with enhancing qualitative characteristics. So these characteristics improve the usefulness of information that is already relevant and faithful represented. They cannot make irrelevant information relevant or information that is not faithfully represented. Think of them as the information that is the as adding extra layers of clarity and comparability to already good information. There are four enhancing qualitative characteristics. First one is comparability. Second one is verifiability, then timeliness and understandability. Let's discuss one by one. Comparability. Information is comparable if it enables users to identify and understand similarities in and differences among atoms across entity or over time. Across entity means it allows users to compare the financial performance and position of different companies. For example, comparing the profitability ratios of two companies in the same industry over time within the same entity. It allows users to track the financial performance and position of a single entity or company or an organization over different accounting periods. For example, comparing a company's revenue growth year on year. So comparability does not mean uniformity. It doesn't mean all companies should use exact same accounting methods in all circumstances. It means that when different methods are used, the differences should be disclosed so users can understand them, and consistency in accounting methods within a company over time is a key aspect of achieving comparability. Second one is verifiability. Verifiability helps ensures users that information faithfully represents the economic phenomena it purports to represent. It means that the different knowledgeable and independent observers could reach consensus, though not necessarily complete agreement, that is particular depiction is a faithful representation. Direct verification and indirect verification. Direct verification, this means directly observing an amount, for example, counting cash, and indirect verification is like, yeah, this means checking the inputs to model, formula, or other techniques and recalculating the outputs using the same methodology. For example, verifying the carrying amount of inventory by checking the cost and quantities. Essentially, verifiability means that the information can be supported by evidence and that if someone else follow the same process, they could arrive at substantially the same results. Timeliness. Timeliness means having information available to decision makers in the time to be capable of influencing their decisions. The older the information, the less useful it is. For example, knowing a company's financial position from 3 years ago is far less useful for a current investment decision than knowing its position from 3 months ago. Okay. There's often a trade-off between timeliness and faithful representation. Highly timely information might be less precise preliminary estimates, while highly precise information might take longer to prepare and thus be less timely. The goal is to provide information quickly enough while still ensuring its reliability. Understandability. Understandability means that information is classified, characterized, and presented clearly and concisely. While financial statements are prepared for users assumed to have a reasonable knowledge of business and economic activities and who are willing to study the information with reasonable diligence, and complex information should be excluded just because it is difficult to understand. Clarity and consistency are key. These involves using clear language, appropriate aggregation, and effective presentation formats. Recap of qualitative characteristics. Qual- Good qualitative characteristics are divided into two types: fundamental and enhancing. Fundamental categorized into two: relevance and faithful representation. Relevance means capable of making a difference in decision, predictive value and confirmatory value and materiality. Faithful representation depicts what it purports to depict, complete, neutral, or free from error. Enhancing comparability, verifiability, timeliness, understandability. Comparability enables identification of similarities and differences. Then verifiability is different independent observers can agree its faithful representation. Timeliness available in time to influence decisions. Understandability clear and concisely presented. So let's start with elements of financial statements. The elements relating to financial position, balance sheet, and statement of financial position. These elements measure the financial position of an entity at a specific point in time. First one is assets, liabilities, and equity. Let's look at each assets. An asset is a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. There are three important things that the results out of past events and from which expected future economic benefit expected to flow to the entity. Okay, let's break down this definition. First one is resource. This implies something of value controlled by entity. That resource must be controlled by the entity. The entity must have the ability to obtain the future economic benefit from the assets and restrict the access of the others to those benefits. Legal ownership is often a sign of control, but not always necessary asset under finance lease. Okay. And as a result of past events, so the asset must have arisen from transaction or event that has already occurred. such as purchase, production, donation, etc., and future transactions cannot give rise to current asset, from which future economic benefits are expected to flow to the entity. This is the core character- characteristic. Economic benefits are the potential to contribute direct the core character directly or indirectly to the flow of cash or cash equivalent to the entity. These benefits can be used in the production of goods or services, machinery, raw material, etc., exchange for other goods, inventory for cash, used to settle liability and distributed to the owners. Example of assets, cash and cash equivalent, like cash bank balances, account receivable debtors, inventory stock, then PPE, property plant equipment such as land, building, machinery, investment, intangible assets such as patents, copyright, trademarks, goodwill, etc. Liabilities. A liability is a present obligation of the entity arising from the past events, the settlement of which is expected to the result in an outflow from the entity's resources embodying economic benefits. Let's break down this definition. Present obligation. The entity has a duty or responsibility to act or perform in a certain way. This obligation exists at the reporting date and not in the future. It can be uh, it can be a legal obligation, such as contract, or constructive obligation, such as established pattern of past practice. Then of the entity, the obligation must be that of the reporting entity. Arising from past events, the obligation must have arisen from transaction or event that has already occurred. For example, purchase of goods on credit, borrowing money, etc. The settlement of which is expected to result in an outflow from the entity's resources embodying economic benefits. To settle the obligation, the entity will have to give up assets, cash, goods, services. This is the key distinguishing feature of a liability. Examples of liability are account payables, also called as creditors, then loans and borrowings, bonds payable, provisions for warranties, employee benefits, etc. Then unearned revenues, advance payments from customer for future services or goods. Equity. Equity is the residual interest in the assets of the entity after deducting all its liabilities. This means that equity is equal to assets minus liabilities. It represents the owner's claim on the assets of the business. It's often referred to by various names depending on the type of entity, such as shareholders' fund or owner's capital in companies, then capital account in proprietorship and partnership. Of then components of equity often includes share capital, funds contributed by owners, reserve and surplus, accumulated profits that have not been distributed as dividends, and retained earnings. The accounting equation, assets is equal to liability plus equity, directly stems from this definition of equity. Do you have any questions on assets, liabilities, or equity? Then we will move on to the next topic. Those are elements relating to the financial performance, that is statement of profit and loss or income statement. Those elements measure the financial performance of an entity over a period of time. Income and expenses. Income. Income is defined as increases in economic benefits during the accounting period in the form of inflows or enhancement of asset or decreases of liabilities that results in increases in equity other than those relating to contribution from equity participants. Let's break down the definition. Increases in economic benefits. This is the core idea. The entity is becoming richer. During the accounting period, income is measured over a specific period, for example, a quarter or a year, in the form of inflows or enhancements of assets. This means the company is receiving assets like cash from sales, or its existing assets are increasing in value. Examples selling goods or for cash increases the cash assets or decreases of liabilities. This means an obligation is reduced without an outflow of economic benefits, leading to an increase in equities, for example, a loan waiver from a branch. That results in increase in equity. Any income ultimately increases the owner's stakes in the business, other than those relating to contribution from equity participants. This is a crucial exclusion. When owners invest more capital into the business, it increases equity and assets, cash, but it's not income. Income comes from operations or other activities of the business, not from owners' direct contribution. Income encompasses both revenue and gains. Revenue arises in the course of the ordinary activities of an entity, for example, sales, fees, interest, dividends, royalties. This is the primary income from the business normal operations. Gains represent other items that meet the definition of income and may or may not arise in the course of the ordinary activities of an entity. They often arise from non-operating activities and might be less frequent, and gain on sale of the fixed assets, gain on revaluation of investments. The examples of income are sales revenue, service fees, interest income, dividend income, gain on sale of property, plant equipment, rent income, etc. Expenses. Expenses are defined as decreases in economic benefits during the accounting period and in the form of outflows or depletion of asset or incur incurrences of liabilities that result in decreases in equity other than those relating to distribution to equity participant. Let's break down this definition. Decreases in economic benefits. The entity is becoming poorer in some way. During the accounting period, expenses are measured over a specific period in the form of outflows or depletions of assets. This means the company is using up assets like cash to pay salaries or inventories and sold, or its existing assets are decreasing in value. Examples, paying salaries reduces cash, using up raw materials in production depletes inventory, or incurrences of liabilities. This means a new obligation is created for an existing person. Other than those relating to the distribution to equity participant, other than those relating to the distribution to equity participant, this is also a crucial exclusion. When the entity pays dividend to shareholders, it decreases the equity and cash, but it's not an expense. It's a distribution of past profits to the owners. Expenses encompasses both expenses arising in the course of ordinary activities and losses. Expenses from ordinary activities such as cost of sales, wages, depreciation, rent, advertising, research and development, these are incurred regularly to generate revenue, whereas losses represent other items that meet the definition of expenses and may or may not arise in the course of ordinary activities of the entity. They often arise from non-operating activities or might be less frequent. For example, loss on sale of a fixed asset, loss from natural disaster, and impairment loss. Example of expenses are cost of goods sold, salaries and wages, rent expenses, depreciation expenses, interest expense, loss on sale of investment, etc. Now we will see relationship between income and expenses. The net effect of income and expenses over a period is either profit when income is greater than expense, or loss when expenses are greater than income. This profit or loss then impacts the equity of the entity. Now we will move on to the next topic. Next topic is recognition and measurement. This section of the framework provides criteria for including items in the financial statements and explains the various measurement bases that can be used. Recognition of elements. Recognition is the process of incorporating into the balance sheet or statement of profit and loss an item that meets the definition of an element and satisfies the criteria for recognition. An item that meets the definition of an element that either asset, liability, equity, income, expense should be recognized if it is probable that any future economic benefit associated with the item will flow to or from the entity. Probable generally means more likely than not. Probability of more than 50%. Current the asset, it means the inflow of benefits is probable, and for liability, it means the outflow of benefits is probable. The item has a cost or value that can be measured with reliability. This means the measurement is free from material error or bias and can be depends upon by users. While estimates are often involved, the measurement must still be reliable enough to be useful. Key implications of recognition criteria. Uncertainty. Even if an atom meets the definition, if the probability of economic benefits flow is not high enough, or if its value cannot be measured reliably, it should not be recognized in the financial statements. Instead, it might be disclosed in the notes to the financial statements. Balance between relevancy and reliability. The recognition criteria aims to strike a balance between providing relevant information by recognizing all items that meet the definition and providing reliable information by ensuring probability and reliable measurement. Then we will see de-recognition. The framework also implicitly covers de-recognition, which is removal of a previously recognized asset or liability from the entity's balance sheet. De-recognition normally occurs when the item no longer meets the definition of an asset or liability. For example, an asset is de-recognized when it is sold, consumed, or expires. It is The framework also implicitly covers derecognition, which is the removal of a previously recognized assets or liability from the entity's balance sheet. Derecognition normally occurs when the item no longer meets the definition of an asset or liability. For example, an asset is recognized when it is sold, consumed, or expires, and liability is derecognized when it is settled. Then we will see the measurement of elements. Measurement is the process of determining the monetary amounts at which the elements of the financial statements are to be recognized and carried in the balance sheet and statement of profit and loss. The framework discusses various basis, and it's important to note that a single measurement basis is rarely used exclusively, and different bases are used for different elements or in different circumstances. The main measurement basis includes historical cost, current cost, realizable value, present value, uh, historical cost, assets, liabilities, strength, weaknesses, common use. Assets recorded at the amount of cash or cash equivalent paid or the fair value of the consideration given to acquire them at the time of their acquisition. Liabilities recorded at the amount of proceeds and received in exchange for obligation or at amounts of cash or cash equivalents expected to be paid to satisfy the liability in the normal course of business. Strength, objective, and verifiable. Then weaknesses may not reflect current values. The common use, most assets like PPE, inventory initially, and liabilities are, are measured at historical cost. Current cost, asset carried at the amount of a cash or cash equivalent that would have to be paid if the same or equivalent asset was acquired currently. Liabilities carried at the undiscounted amount of cash or cash equivalent that would be required to settle the obligation currently. Strength reflects current value. Weaknesses less objective and verifiable. Common use revaluation of certain assets, although less prevalent for the entire financial statement. Realizable settlement value assets carried at the amount of cash or cash equivalent that could currently be obtained by selling the assets in an orderly disposal. Liabilities carried at their settlement values that undiscounted amount of cash or cash equivalents expected to be paid to satisfy the liabilities in the normal course of business. Common use, so inventory uh, for inventory at a net realizable value and certain financial instruments. Present value is the discounted rate value. Assets carried at the present discounted value of the future net cash inflows or outflows that then the item is expected to generate in the normal course of business. So net cash inflows that the item is expected to generate in the normal course of business. So we are performing we are considering time value of money over here. Liabilities carried at present discounted value of the future net cash outflows that are expected to be required to settle liabilities in the normal course of business. Strength reflects the time value of money. Common use, the long-term liabilities such as bonds, provisions for long-term obligation, certain complex financial instruments. Now, choice of measurement base. The framework does not prescribe which measurement base to use for which item. Instead, it discusses the characteristics of they relate, each and how they relate to the qualitative characteristics. Historical cost is highly reliable. Current cost is more relevant. In the inflationary times, accounting standard, India's and AS then specifies the appropriate measurement basis for particular assets, liabilities, income, and expenses. Now we will see the concept of capital and capital maintenance. This section discusses different concepts of capital and how profit is determined under each concept. The choice of capital concept influences how an entity measures its profit or loss. There are two main concepts of capital maintenance. Concepts of capital maintenance, such as financial capital maintenance and physical capital maintenance. Financial capital concepts. Under the concept, capital is defined in terms of nominal monetary amount of the net assets or invested purchasing power. The focus of financial capital mm, is of the views capital as the monetary amount of the equity invested in the entity. Maintenance. Financial capital is maintained if its monetary amount of the net assets at the end of the period exceeds the monetary amount of the net assets at the beginning of the period, after excluding distributions to and contributions from owners. Profit is earned only if the financial monetary amount of the net assets at the end of the period is greater than that that at the beginning of the period. The assets at the beginning of the period after accounting for any distribution to or contribution from owners. Now we'll see the measurement. This concept is typically associated with historical cost accounting of other measurement bases that focuses on monetary amounts. Example, if a company starts the year with a monetary capital of 1 lakh rupees and ends the year with a capital of 1 lakh 20,000 rupees after no owner contribution or distribution, it has made a profit of rupees 20,000. Under this concept, general price level changes, inflation are generally ignored for the profit calculation. Physical capital concept. Under this concept, capital is defined in terms of physical productive capacity of the entity. Focus. It reviews capital as the operating capability of the entity represented by its physical assets, that physical uh, machinery and inventory, etc. Maintenance. Physical capital is maintained if the physical productive capacity or the resources or funds needed to achieve that capacity at the end of the period is equal or exceeds the physical productive capacity at the beginning of the period, after excluding distribution to or contribution from owners. Sorry. Profit. Profit is earned only if the physical productive capacity of the entity at the end of the period is greater than its physical productive capacity at the beginning of that period, after accounting for any distributions or contribution from owners. Measurement. This concept requires the use of the current cost or other measurement places that reflect the current cost of replacing the entity's productive capacity. It accounts for the impact of changing prices on the operating capability of the entity. Here, for example, if a company starts the year with a machine costing 1 lakh rupees, and by the year end, the cost of replace that machine, its current cost has increased to be 2 rupees 1 lakh 10,000 due to the inflation. Under the physical capital maintenance, a company would only recognize profit after it has set aside enough to replace that machine at its current cost, and the rupees 10,000 increase in replacement cost would be treated as a capital maintenance adjustment, not profit available for distribution. Relationship with profit measurement, financial capital maintenance. If this concept is adopted, profit represents the increase in the nominal monetary capital. Most traditional accounting models, including those based on the historical cost, allow this concept. Physical capital maintenance. If this concept is adopted, profit represents the increase in the physical productive capacity. This concept requires current value accounting and implicitly consider the impact of inflation on the ability to replace assets. Which concept does the framework prefer? The framework acknowledges both concepts but does not express a preference for one over the other. The choice between the two concepts depends on the needs of the users of the financial statement. The financial capital concept is more widely adopted in practice primarily because it's simpler to apply and historical costs are more verifiable. The physical capital concept might be more relevant in periods of high inflation as it provides a more realistic view of sustainable earnings that can be distributed without eroding the entity's operational capacity. This concludes the main sections of the framework of preparation and presentation of financial statement. Now we have completed basic understanding of framework for preparation and presentation of financial statement. Now we will see what ICI want to state about this concept. Now we'll see the framework for preparation and presentation of financial statement from ICI study material, the learning outcome, to understand the meaning and significance of framework for the preparation and presentation of financial statement, learn objectives of financial statement, understand qualitative characteristics of financial statement, comprehend recognition and measurement of elements of financial statement, then know the concept of capital maintenance, and determination of profit. Chapter overview. The framework set out the concept underlining the preparation and presentation of general purpose financial statements prepared by the enterprises for a wide range of users. The Accounting Standards Board (ASB) of the Institute of Chartered Accountants of India (ICI) issue a framework for the preparation and presentation of financial statement in July 2000. This framework is relevant in context of companies accounting standards rules 2021, which has replaced companies accounting standards rules 2006 as amended from time to time notified by the central government and accounting standard issued by the ICI. This framework provides the fundamental basis for the development of a new standards as also for review of existing standards. This framework also explains components of financial statements, users of financial statement, qualitative characteristics of financial statement, and elements of financial statement. The framework also explains the concept of capital maintenance, and determination of profit. Introduction. The development of accounting standards or any other accounting guidelines needs a foundation of underlying principles. ESB of ICI issue a framework in July 2000 which provides the fundamental basis for the development of new standards as also for review of existing standards. The principal areas covered by the framework are as follows: components of financial statement, objectives of financial statement, assumptions underlying the financial statement, and qualitative characteristics of, of financial statement, then elements of financial statement. That it also covers criteria for recognition of elements of financial statement, then principles for measurement of financial statement, and concepts of capital and capital maintenance. The purpose of the framework. The framework sets out the concepts underlying the preparation and presentation of general purpose financial statement prepared by enterprises for external users. The main purpose of the framework is to assist enterprises in preparation of their financial statements in compliance with the accounting standards and in dealing with topics not yet covered by any accounting standards. In generalization framework for the preparation and presentation of financial statements. ASB in its task of development and review of accounting standard. So the purpose of the framework is for ASB for the development and review of accounting standards, which we have seen over here. Development of new standard, also review of existing standard. Okay. Now, ASB in promoting harmonization of regulation, then accounting standards and procedures relating to the preparation and presentation of financial statement by providing a basis for reducing the number of alternative accounting treatments, reducing alternative accounting treatments and permitted by accounting standard. Now, auditors informing an opinion, auditor by forming an opinion. as to whether the financial statement conform to the accounting standards. Then users in interpretation of financial statement and those who are interested in the work of ASB with information about its approach and formulation of accounting standards. So this is flexible. Now we will see status and scope of the framework. The framework applies to general purpose financial statement, hereafter referred to as the financial statement, usually prepared annually for external users by all commercial, industrial, and business expert enterprises, whether in public or private sector. The special purpose financial reports, for example, computation prepared for tax purposes, are outside the scope of the framework. Nevertheless, the framework may be applied in preparation of such reports to the extent not inconsistent with the requirements. With their requirements. Nothing in the framework overrides any specific accounting standard. In case of a conflict between an accounting standard and the framework, the requirements of the accounting standards will prevail over those of the framework. Components of financial statement. A complete set of financial statement normally consists of a balance sheet, a statement of profit and loss statement, and cash flow statement together with the notes. Other statements and explanatory material that form an integral part of financial statement. All components of financial statements are interrelated because they reflect different aspects of same transactions or other assets. Although each statement provides information that is different from each other, none in isolation is likely to serve any single purpose, nor can anyone provide all information needed by a user. The major information concepts of the different components of a financial statement are explained as below. Balance sheet portrays value of economic resources controlled by an enterprise. It also provides information about liquidity solvency of an enterprise, which is useful in predicting the ability of enterprise to meet its financial commitments as they fall due. Statement of profit and loss presents the result of operations of an enterprise for an accounting period. It depicts the performance of an enterprise, in particular its profitability. Cash flow statement shows the way an enterprise has generated cash and the way they have been used in an accounting period and helps in evaluating, investing, financing, operating activities during the reporting period. Notes and other statements present supplementary information explaining different items of financial statement. For example, they may contain additional information that is relevant to the needs of the users about the items in the balance sheet and statement about profit and loss. They include various other disclosures such as disclosure of accounting policies, segment reporting, related party disclosure, earning per share, objectives and uses of financial statement. The objectives of financial statement is to provide information about the financial position, performance and cash flows of an enterprise that is useful to a wide range of users in making economic decisions. The framework identifies seven broad groups of users of financial statement. Hello. Now, the opposite users use financial statement in order to satisfy some of their information needs. Now, the upper state users use financial statement in order to satisfy some of their information needs. These needs may include the following: investors, employees, lenders, suppliers, customers, government and their agency, and public. What are those needs? The providers of risk capital are concerned. The providers of risk capital are concerned with the risk inherent in and return provided by their investment. They are also interested in information which enables them to assess the ability of the enterprise to pay dividends. So they are concerned with risk inherent in and returns provided by their investment and the ability of enterprise to pay dividend. Employees and their representative groups are interested in information about the stability and profitability of their employers. And they are also interested in information which enables them to assess the ability of the enterprise to provide remuneration, retirement, ability to pay retirement benefits, and employment opportunities. Okay, lenders. They are interested in the information which enables them to determine whether their loans and the interest attaching to them will be paid when due. Suppliers and trade creditors. Suppliers and other creditors are interested in the information which enables them to determine whether the amount owing to them will be paid when due. Whether the amount owing to them will be paid when due. Trade creditors are likely to be interested in the enterprise over a shorter period than lenders unless they are dependent upon the continuous of enterprise as a major customer. Customers have an interest in the information about the continuance of enterprise, especially when they have long-term involvement or with or dependent on the enterprise for the goods or services. Governments and their agencies are interested in the allocation of resources, in the interest in the allocation of resources and therefore the activities of the enterprise. This They also require informations in order to regulate the activities of the enterprise and determine taxation policies, regulate the activity and determine the taxation policies, and to serve as the basis for determination of national income and similar statistics. Public enterprises affect members of the public in variety of ways. For example, enterprise may make a substantial contribution to the local economy in many ways, including the number of people they employ and their patronage of local suppliers. Financial statements may assist the public by providing information about the trends and recent developments in the prosperity of the enterprise and the range of its activities. Okay. Now, fundamental accounting assumptions we have already covered in our last lecture. Those are going concern, accrual, and consistency. These are the assumptions at such that the users of financial statement believe that the same has been considered while preparing and presenting the financial statements. That is why, as long as financial statements are preparing in accordance with this assumption, no separate disclosures in financial statement would be necessary. If nothing has been written about the fundamental accounting assumption in the financial statement, then it is assumed that they have been that they have already been followed in their preparation of financial statements. However, if any of the above mentioned fundamental accounting assumption is not followed, then this fact should be specifically disclosed. Let us discuss this conception and these assumptions in detail. The going concern, the financial statements are normally prepared on the assumption that an enterprise will continue in operation in the foreseeable future, and neither there is an intention nor there is a need to materially curtail the scale of operation. Financial statements prepared on going concern basis recognize, among the other things, the need for sufficient retention of profit to replace assets consumed in operations and for making adequate provision of settlement of its liability. If any financial statement is prepared on a different basis, so that when the assets of an enterprise are stated at a net realizable values in its financial statement, then the basis should be disclosed. Here is the balance sheet of a trader operated on 31st March 2021 is given below. So additional information. The remaining life of PPE is 5 years. And the pattern of use of the asset is given. And the net realizable value of PPE of equipment is 60,000. 60,000. The traders purchase and sales amounted to 4 lakhs and 4.1 lakh respectively. The cost of net realizable value of stock as on 31st March uh, 2022 were rupees 32,000 and 40,000 respectively. Expenses including interest 10% and amounted to 14,900. Deferred expenditure is amortized equally over 4 years. Trade receivable uh, as on 31st March 2022 is 25,000, of which 2,000 is doubtful, and collection of another 4,000 depends on the successful reinstallation of a certain product and supplier to the customer. Closing trade payable rupees to 12,000, which is likely to be settled at a 5% discount. Cash balance as on 31st March 2022 is 37,100, and there is an early repayment penalty for the loan that is 22,500. You are required to prepare profit and loss statement on the balance sheet of the traders in both cases, assuming going concern and not assuming going concern. So there are two cases, and we have to prepare the profit and loss statement. Okay. First, we will start with profit and loss statement. So here, the opening, the balance sheet that we have given. From that, we will get the opening stock for profit and loss account. What is the opening stock for here? The opening stock is 30,000. So here we are taking opening stock. For both in both scenario, it will be the same. And here we will see the closing stock. Okay. The remaining out of PP now, this is not a view. Traders purchase and sales of 4 lakh and 4 trader purchases and sales. So 4 lakhs and 1.5 lakh difference. The cost and net realizable value 32,000 and 40,000. So in the cost and net realizable stock about. So here they have given the if the we have considered the if we have to if it is in going concern situation, then the closing stock will be co lower of the cost of net realizable value of stock, which is 32,000. In that case, it will be 30,000. But when it is in there is not if we are not assuming the going concern. If assume going concern lower of cost or net realizable value, that is 32,000 will be the closing value of closing stock. And if you are considering is not we are not considering the assumption of going concern, then it will be the net realizable value for the asset, and that is 40,000 for closing stock. So this also clear. Now we'll see the purchases. For purchases, traders purchases, that is 4 lakh and 4.5 lakh respectively. So here the 4 lakh purchase is 4 lakh and sale is 4.5 lakh. So there will be no any change. You have to take it on current values only. Now, so this has been used. This has been used. Now, now we will see the expenses. So expenses uh, always calculated on current values, and depreciation. So expenses, where are the expenses? Historical. So expense including interest of 10% of rupees 30 for the year amounted for the rupees 14,900. So this is okay. And loan, okay. So taken. Now we will consider depreciation. So PP for 5 years. What is PP? Is 65,000. So divided by 5, 12,000. So it becomes 60 minus 12. minus 53,000. Here the depreciation will be 65 now, 35, 13,000. So 60 minus 52,000. So depreciation is 13,000. So it's okay. Depreciation is okay. Or with assumption of going concern or not assuming going concern, then the this value will be 53,000, 52,000 will be the 52,000 will be the value of PPE, and the depreciation, the further if you are not consuming the assets, so we have to depreciate for 5 years now, 4 years and remaining 65,000 minus 13,000, 52,000. So for the assets, we need to calculate the depreciation. So make it question mark. We will see it. Once we make or make it on net realizable value. For example, if we have to make it 60,000, so we just have to keep the if you have to make it on net realizable value, that is 60,000, and we don't depreciate it by 13,000 and make it 50,000. We just depreciated it by 5,000 to keep it on a net realizable value. That's why here we will consider 5,000 rupees. Okay, so it is different. This is the first case where the assumption impact on the P&L. Okay, now the provision for doubtful debts. Now here we can see this will be covered. This will be covered. Okay, deferred. I say amortized over deferred expenditure is amortized equally over 4 years. So here we have deferred expenditure that is 10,000, which we have to amortize over the period. So over if we then it will be 10,000 4 years, for per year is 2,500. So here it should be 2,500. But if it we have to if in case of we're not assuming going concern, it will become 10,000. So here the case normally if we have to amortize it over 4 years. So we will take 2,500. But if there is no uh, assumption of going concern, then in that case we have to expense out completely. So we have take it over here as 10,000. So this case also has been covered. Then trade receivable as on date of the year is 25,000, of which 2,000 is the doubtful collections. If it is doubtful collection in normal course of business, we will take it. And if it's not in if it then not if it is not normal course of business, then if we have to so in normal course of business, we will take this doubtful collection under consideration. And if rupees 4,000 is successful installation of a certain product. So if there is no going concern, then there will be no any um, successful installation. So we need to consider this 4,000 also over here for 6,000 as 6,000 for current year loss or expense only. So in trade payables, we have considered a trade receivable, because here in the case of trade receivable, when we see this is 25,000, out of 25,000, 2,000 is a doubtful collection of of another of another 4,000 depends on the successful doubtful, and the collection of another 4,000 depends on the successful installation of a certain product or supply of customer. But we if there is no operations in the future, that means this 4,000 we have to correspond, and this is the expense for the year. So we have considered it for year. Okay. Now, by trade payables, when I say closing trade payables is 12,000. What is Okay, now the closed rate payable is 12,000 and which is likely to be settled at a 5%. Then the closed rate payable is 12,000. We have to settle it at the 5%. So normally, if it's 12,000, then we don't have to settle it quickly. And if the business is going on, but if there is a not assumption of going concern, then we have to settle the 5%, that is 600 rupees. So this also we have considered. Now we'll consider loan penalty. Now here we have seen this also considered cash balance as on this is a balance sheet item. Now there is an early repayment penalty for the loan um, of rupees 2 lakh 2,500, because if you are not operating, then we have to pay this penalty of rupees 2,500. That's we are considering this penalty for not uh, having the assumption of going concern. Otherwise, we do need to take this penalty. We can pay the loan on. We don't pay the loan early. Okay, in normal course of business. On time, we will pay. Then the net profit. So we will make the calculation and uh, find out this balance figure. Okay. And this the capital would be 6,000. Then per asset will be recognized at net realizable value in the case of not having a going concern consumption. Stock also we will consider at net realizable value, and otherwise we will take present on the cost lower of the cost of net realizable value. Okay, and at the historic assets at the PP at the historical cost, that is 52,000. Then we will see the trade receivable. Wait a second. Okay. So what we have completed over here, that the closing trade balance 12,000, which is likely to be 5% if we need to be settled down to at 600 rupees. Okay. So profit and loss account, we get 10% of loan in trade payables. We are at trade receivable less provision. So if I take trade receivable, how much it was? 25,000. Out of that, 2,000 for going concern, so 23,000. And we're not having concern, we have to subtract 6,000, so 19,000. Is it like that? Okay, this is right. Yeah. Okay, let's continue to 23,600. This is clear. Now we have to do deferred expenditure. Deferred expenditure, deferred expenditure over 5 years, if we consider then through 10,000 divided by 2,500, that is 7,500. And if and going concern 10,000 only, so it becomes nil. So we expense out entirely, then it becomes nil. Okay, now trade payables. So we have seen here trade payables. Where are the trade payable 12,000. Out of that, 5% discount. So if you have to settle down, so generally, if it is there will be 12,000, it should be continued. But we have to give the discount of 5%. So we take 12,000 into 95%. That is 11,400. This will be in the case of having going concern. And we see seek for the loan, 10% loan. Then in case of 10% loan, you have to pay 35,000 per year, including interest of 25,000 per year. And what was the loan? Amount is 14,900. Out of that, you have to pay 3,500. So your loan will be 11, so 25,000. So let us see. Hmm. Expenses included 10% of loan of 35,000 per for the year. So we have to make this is okay, just a moment. First account, but we have to. And this is it 3,500 is for per year. Is the 10% of the loan, then the total loan is equal to 35,000. So it is 35,000. And in case if you have to early close it, we have to give 35,000 also. And there's a penalty of 2,500 also. So the loan we have to provide will be 37,500. Okay. Yeah. Now finish the profit and loss account. There is a Now we have to find out the bank balance first. So in bank balance, here it is cash balance either 37,100. So now we have to find out the balancing figures, and these are the balancing figure. There is the profit and loss account. Solved. Now we'll see the accrual basis. According to the AS1, revenues and costs are accrued. Revenue and cost are accrued, that is recognized as they are earned or incurred and not as the money received or paid. So, and recorded in the financial statement of the periods to which they relate. Further, the Section 128, subsection 1 of the Companies Act 2013 makes it mandatory for companies to maintain accounts on accrual basis only. It is not possible, it is not necessary to expressly state that the accrual basis of the accounting has been followed in the preparation and presentation of financial statement, but in case any income or expenses recognized on cash basis, then the PAT should be stated. Let's understand the impact of the both approaches of the accounting by way of an example. A trader purchases an article on credit in the period one of rupees 15,000. He also purchased an article in period one for the period of rupees of 2,000 cash, and the trader sold the article in a period one for rupees 60,000 in cash. He also sold article B in period one for rupees 2,500 on credit. Profit and loss account of the trader by two bases of accounting are shown below, and a look at the cash basis of profit and loss account will convince any reader of the irrationality of the cash basis of accounting. Cash basis of accounting, cash purposes of Article B and cash sale of Article A is recognized in period A, while the purchase of Article A on the payment and sale of the Article B on receipt is recognized in period 2. Here we can see, so what we have purchased, Article A on credit, we have purchased. So we have, on active basis, we have to take in 50,000, and the sale credit, and also purchase an article in cash of 2,000 rupees. So we can say that 2,000, if we on a cash basis we take this, we will take this 2,000, and sale cash sale will take of 60,000. This is cash sale and cash. So this is on cash basis and period, and this is on what we can say on the basis of accrual basis. So here purchase 50,000, sale to 2,500, the net loss will be 47,000 on accrual basis. Whereas on cash basis, we can see it is nullified. There is no profit, no loss to the situation. So here we can say this is the cash basis of accounting. Whereas on accrual basis of accounting, cash basis. So in cash basis of accounting, period one has no profit and losses. In period two, when we receive those payments, there would be the loss of 47,500. But on accrual basis, if you take, and this is for example for period one, uh, oh, we will give the net profit of 10,500. We are considered on credit basis all these transactions when we discuss about actual basis of accounting. Then we will see consistency. It is assumed that the accounting policies are consistent from one period to another, and the consistency improves the comparability of financial statement through time. According to the accounting standard, an accounting policy can be changed if the change is required by a statute, by accounting standard, or for more appropriate presentation of financial statement. Then now we will see the qualitative characteristic of financial statement. The qualitative characteristics are attributes that improves the usefulness of the information provided in the financial statements. The framework suggests that the financial statement should observe and maintain the following four qualitative characteristics as far as possible within the limits reasonable cost and benefits. Qualitative characteristics: understandability, relevance, comparability, reliability. URCR. Understanding, relevance, comparability, reliability. So here's these attributes can be explained. The understandability, the financial statement should present financial information in a manner as to be readily understandable by users with reasonable knowledge of business and economic activities and accounting. Relevance, it is not right to think that more information is always better. A mass of irrelevant information creates confusion and can be even more harmful than non-disclosure. The mass and the financial statement should contain relevant information only, information which is likely to influence the economic decisions by the users is said to be relevant. Such information may help the users to evaluate past, present, and future events, or may help in confirming and correcting past evaluations. This relevance of a piece of information should be judged by its materiality. Piece of information is said to be material if its misstatement, or such that omission or erroneous statement can influence economic decision of an user taken on the basis of financial information. When materiality depends on the size and nature of the item or error judged in the specific circumstances of its statement. Mortality provides a threshold or cutoff point rather than being a primary qualitative characteristics which the information must have if it is to be useful. Further, it is important to know the constraints also on relevant and reliable information to better understand the qualitative characteristics of financial statement. Following are some constraints: timeliness, balance between benefits and cost. Timeliness. If there is undue delay in the reporting of financial information, it may lose its relevance. The management may need to balance the relative merits of the timely reporting and the provision of reliable information. To provide the information on timely basis, it may often to be necessary to report before all aspects of the transactions and other events are known, thus impairing reliability. Conversely, if the reporting is delayed until all aspects are known, the information may be highly reliable but of little use to users who have had to make decisions in the interim. In achieving a balance between relevance and reliability, the overriding consideration is how best to satisfy the information needs of users. Balance between benefits and costs. The balance between benefit and cost is a pervasive constraint rather than a qualitative characteristics. The benefits derived from information should exceed the cost of providing it. The evaluation of benefits and cost is, however, substantially a judgmental process. The preparers and users of financial statement should be aware of this constraint. Then reliability. To be useful, the information must be reliable. That is to say, they must be free from material errors and bias. The information provided are not likely to be reliable unless the transaction and events reported are faithfully represented, and the transaction and events are reported on the principle of substance or form. Then the reporting transaction and events are neutral, free from biases. Prudence is exercised in reporting uncertain outcome of transactions or events. The information in financial statement must be complete. Comparability. Comparison of financial statement is one of the most frequent used and most effective tool of financial analysis. The financial statement should permit both inter-firm and intra-firm comparison. One essential requirement of comparability is disclosure of financial effects of change in accounting policies. However, the need for comparability should not be confused with mere uniformity and should not be allowed to become an impediment to the introduction of an improved accounting standard. It is not appropriate for enterprise to continue accounting in the same manner for a transaction or other event if the policy adopted is not keeping with the qualitative characteristics of relevance and reliability. It is also appropriate for enterprise to leave its accounting policy unchanged when more relevant and reliable alternatives exist. True and fair view. The financial statements are required to show a true and fair view of the performance, financial position, and cash flow of an enterprise. The framework does not deal directly with this concept of a true and fair view. It application of the principles quality to characteristics and appropriate accounting standards normally results in financial statement portraying true and fair view of the information about an enterprise. Elements of a financial statement. The framework classifies items of financial statement in five broad groups depending on their economic characteristics: assets, liquidity, liability, equity, income, and expenses. Gains and losses differ from the income and expenses in the sense of that they may or may not arise in ordinary course of business, expect, except for the way they arise. Economic characteristics of gains are same as income, and those of losses are same as expenses. For these reasons, gains and losses are not recognized as a separate elements of the financial statements. Let's discuss each element of the financial statement in detail. First one is asset. An asset is a resource controlled by the enterprise as a result of past events from which future economic benefits are expected to flow to the enterprise. The following points must be considered while recognizing an asset. The resources regarded as an asset need not have a physical substance. The resources may represent a right generating future economic benefits such as patents, copyrights, trade receivable, and intangible assets. An asset without a physical substance can uh, either intangible asset, for example, patent, copyright, or monetary asset, or trade receivable, for example, trade receivable, uh, right, or monetary assets, for example, trade receivable. The monetary assets are money held and assets to be received in fixed and money, determinable amount of money. An asset is a resource controlled by the enterprise. This means it is possible to recognize a resource not owned but controlled by the enterprise as an asset. Legal ownership may or may not vest with the enterprise. Such is a case of a financial lease where lessee recognizes the asset taken on lease, even if the ownership lies with the lessor. Likewise, the lessor does not recognize the asset given on finance lease as an asset in his book because the respect of ownership, he does not control the asset. The resource cannot be recognized as an asset if the control is not sufficient for this reason. Specific management or technical talent of an employee cannot be recognized because of the insufficient control. When the control over the resources is protected by a legal right, for example, copyright, the resources can be recognized as an asset. To be considered as an asset, it must be probable that the resource generates future economic benefits. If the economic benefits from a resource is expected to expire within the current accounting period, is not an asset. For example, economic benefits, for example, such that profit on sale from machinery purchased by an enterprise who deals in such kind of machinery is expected to expire within a current accounting period, and such purchase of machinery is therefore booked as an expense rather than capitalized in the machinery account. However, if the articles purchased by a dealer maintained unsold at the end of the accounting period, and the unsold items are recognized as assets, so that closing stock because of the sale of the article and resultant economic benefits, so the profit is expected to be earned in the next accounting period. To be considered as an asset, the resource must have a cost or value that can be measured reliably. Now, when flow of economic benefit to the enterprise beyond the current accounting period is considered improbable, then the expenditure incurred is recognized as an expense rather than an asset. A liability is a present obligation of the enterprise. We will take 5 minutes break. Expenses are stop. Expenses are always incurred simultaneously with either reduction of asset or increase of liability. Thus, expenses are recognized when the corresponding decrease of asset or increase in liability are recognized by the application of the uh, recognition criteria as stated above. Expenses are recognized in profit and loss account by matching them with the revenue generated. However, the application of the matching concept should not result in the recognition of an item as an asset or liability which does not meet the definition of assets or liability as the case may be, where the economic benefits are expected to arise over several accounting periods, then expenses are recognized in the profit and loss statement on the basis of the systematic and rational allocation procedures. The obvious example is depreciation. Okay, now an expense is recognized immediately in the profit and loss account statement when it does not meet or ceases to meet the definition of asset or when no future economic benefit is expected. An expense is also recognized in the profit and loss statement when the liability is incurred without recognition of an asset, as is the case when liability under a product warranty arises. Now we will see the example in the same kind of opening. Begin alliance support by trader hands. There are opening asset, liability, equity. Opening 502 and equity was 3. Now wages paid 2000. So wages paid, that means liability decreases by 2000. 1.8 value 3 2.8. Liability and so it will increase now. Equity will increase. Wages paid. No. So it's not liability. So wages paid would be 4.0 4.98 will become 3.98 2.98. B. Rent outstanding of rupees. Treat us as the transaction rate outstanding of rupees drawing of 4,000 rupees. So what we will draw 4,000 rupees. So your asset will decrease. So it will become 4.96. Before that, we have to take this rent outstanding. So liability increases by 2.1, 4.98 is equal to 2.88. Now, drawings of 4,000, that is 4,000, 58, 98,000. 4.94, 2.1. And then this is 4,000. It should be replaced. It should be replaced. This is 8. So it becomes 4. Let me check. Yeah, after this. Okay. So in our example, we have to take. Let's consider it's like it was 4.98. We start from that on 4.98 minus 1.69 into 3.29 asset liability equity opening. Yeah. Then A, wages paid 2,000. So by 2,000 rupees, it will decrease. Then 1.69 as 2.27. Right? Okay. Now B, rent outstanding liability increases by 1,000. 4.96, 3.28, 2.226. Okay, right. C, and drawing decreases the asset by 4,000, then it will become 1.70, then it will become, this will decrease by 4,000 to 3.22. Done. The example given above explain the definition of expense. The equity decreased by rupees 7,000 from 3.29 and 29 lakhs to 3.22. So all these things happen, and here we can see the closing equity and T closing assets minus closing liability, and opening equity, opening asset minus opening liability. And C is the capital entry rules, and D is drawings. So income minus expense when capital employed Here you need to understand that this equation. So when I say profit, or when we have to find profit, it is asset minus liability minus operational asset minus operational closing asset minus closing liability minus opening asset minus opening liability plus minus we have to consider uh, capital introduced plus drawing. So this is the formula of profit. Profit is equal to closing asset minus opening asset plus closing asset minus opening liability minus closing liability minus opening liability liability plus capital drawings capital introduced minus drawing. And so profit we need to so what we do drawing minus capital introduced. This would be our profit. So for examples, that is current asset closing asset minus closing liability plus opening asset minus opening liability minus capital introduced plus drawing will be your profit. Now, from the above can one can see that the profit depends on the values of assets and liabilities, and since historical costs are mostly used for the valuation, the reported profits are mostly based on the historical cost convention, and the framework recognizes the other method of valuation as of asset liability. And the point to note is that reported figures of profit change with the changes in the valuation basis, and conceptually, this is the foundation of the capital maintenance. Okay, now we'll see the measurement of elements of the financial statement. The measurement is the process of determining money value at which an element can. Now we'll see the measurement of elements of a financial statement. Measurement is the process of determining money value at which Measurement is the process of determining money value at which the element can be recognized in the balance sheet or a statement of a profit and loss. The framework recognizes four alternative measurement bases. The bases relate explicitly to the valuation of assets and liabilities. The valuation of income or expenses so that profit is implied by the value of change in assets and liability. One is historical cost, current cost, realizable value, and present value. In preparation of financial statement, all or any of the measurement bases can be used in varying combination to assign money values to its subject to the requirements under the accounting standards. However, it may be noted that the accounting standards largely uses the historical cost for the purpose of preparation of financial statement, though for some items use of the other value permitted. For example, inventory is recorded at the historical cost on its acquisition. However, at the end, it is valued at a lower of the cost and net realizable value. A brief explanation of each measurement basis is as follows. Historical cost. Historical cost means the acquisition price. For example, the businessman paid rupees 7 lakh to purchase the machine, and its acquisition price, including installation charges, is rupees 8 lakh. Then the historical cost of the machine would be rupees 8 lakh. According to this, the assets are recorded at an amount of cash or cash equivalent paid or the fair value of asset at the time of acquisition. Liabilities are recorded at the amount of proceeds received in exchange for the obligation. In certain circumstances, a liability is recorded at the amount of cash or cash equivalent expected to be paid to satisfy the obligation in the normal course of business. When Mr. X, a businessman, takes rupees 5 lakh loan from the bank at the rate of 10% interest rate per annum, it is to be recorded at the amount received in the exchange of the application. Here, the obligation is the repayment of a loan as well as the payment of interest at an aggregate rate of 10%. Proceeds to the receipts at rupees 5 lakh, and it is the historical cost of the transaction. And take another case regarding the payment of the income tax liability. You know that the every individual has to pay income tax on his income if it exceeds certain minimum limit. But the income tax liability is not settled immediately when one earns his income. The income tax authority settles it sometimes later, which is technically called as assessment year. Then how does he record this liability? As per the historical cost basis, it is to be recorded at an amount expected to be paid to discharge the liability. For example, Mr. X purchased a machine on 1st January 2021 at the rupees of 7 lakh, and as per the historical cost basis, he has to record it at a rupees 7 lakh, and such that the acquisition price as on 1st January 2026, Mr. X found that it would cost rupees 25 lakh to purchase that machine. Mr. X also took loan from a bank as on 2021 for rupees 5 lakh at 18% per annum, repayable at the end of the 15th year together with the interest. As per historical cost, the liability records at rupees 5 lakh and the amount of proceeds received in the exchange of the obligation, the asset is reported at rupees 7 lakh. The current cost gives an alternative measurement basis. Assets are carried at the amount of cash or cash equivalent that would have to be paid if the same or equivalent asset was acquired. Currently, liabilities are carried at the undiscounted amount of cash or cash equivalent that would be required to settle the obligation currently. For a machine was acquired for dollar 10,000 on deferred payment basis, the rate of exchange at the time of acquisition was rupees 49 per dollar. The payments are to be made in the five equal annual installments together with the 10% interest per year. Then the current value of the similar machine will be rupees 5 lakh, and the current market price will be 5 lakh rupees. By historical cost convention, the machine would have been recorded at 4 lakh 90,000. And to settle the deferred payment on the current date, one must buy dollars at 49 lakh 49 rupees per dollar, and the liability is therefore recognized at 4 lakh 90,000. Note that amount of liability recognized is not the present value of the future payments, but this is the because the current cost convention liabilities are recognized at undiscounted amount. Then a realizable settlement value for asset. This is amount of cash or cash equivalent currently realizable on sale of the asset in an ordinary disposal. For liabilities, this is the undiscounted amount of cash or cash equivalents expected to be paid on settlement of liability in the normal course of business. Present value. Present value carried at the present value of the future net cash inflows that is expected. The assets are carried out at the present value of the future net cash inflows that the item is expected to generate in the normal course of business. Liabilities are carried at a present value of the future net cash flow that are expected to be required to settle the liabilities in the normal course of business. Present value P is an amount one has to invest on a current date to have an amount E after n years. If the rate of interest is R, then A is equal to P plus 1 plus P. A is equal to principal into 1 plus R raised to the power n. And P present value after E, up, present value of E after n years will become 1 plus R power raised to the power n. The process of obtaining present value of the future cash flow is called discounting. The rate of interest used for discounting is called a discounting rate, and the expression one divided by one plus r raised to the power n is called discounting factor, and which depends on the values of r and n. Let us take the numerical example for the example assuming interest rate trend. So E is equal to 11,000 and we have to n is equal to 1. Then its the present value become 1 plus 1 raised to the power raised to point 1 raised to the power again. That is where again is equal to 1. So 11 is equal to 11 is to the power 1.1, that is 11,000. So that is the 10,000. So note that the receipt of rupees 10,000 present value now is equivalent to the receipt of 11,000 future cash inflows after 1 year, because if one gets rupees 10,000 now, he can invest it to collect rupees 11,000 after 1 year. Likewise, a payment of rupees 10,000 present value now is equivalent of paying rupees 11,000 future cash outflow after 1 year. Yeah, the second asset generates rupees 11,000 after 1 year. It is actually contributing rupees 10,000 at the current date if the current rate of earning required is 10%. In other words, the value of the asset is 10, rupees 10,000, which is the present value of the net future cash inflow it generates. If an asset generates rupees 11,000 after 1 year and 12,100 after 2 years, then it is actually contributing 20,000 approximately at the current date if the rate of earning required rupees 10% by this calculation. Now, in other words, the value of the asset is 20,000 approximately, so that the present value of net future cash inflow it generates. Now, under the present value convention, assets are carried at a present value of a future net cash flow generated by the concerned asset in the normal course of business. Liabilities under this convention are carried at the present value of the future net cash flows that are expected to be required to settle the liability in the normal course of business. Carrying amount of the machine is rupees carrying amount of the machine is rupees 40,000. Historical cost less depreciation, and the machine is expected to generate rupees 10,000 net cash inflow. The net realizable value or net selling price of the machine on current date is rupees 35,000. The enterprise required to earning rate is 10% per year. Then the enterprise can either use the machine to earn rupees 10,000 for 5 years, and this is equivalent of receiving present value of rupees 10,000 for 5 years at a discounting rate of 10% on the current date. The value realized by use of the asset is called the value in use. And the value in use is the value of asset by present value convention. The value in is equal to it will be 37,900 and net selling price is 35,000. Then the present value of the asset is equal to 37,900, which is called the recoverable value, and it is obviously not appropriate to carry any asset at a value higher than the recoverable value. Thus, the asset is currently overstated by rupees 2,100, 14,000 minus 37,900. Now we will see the capital maintenance and there will be and physical capital, financial capital and physical capital, and then we'll come to the summary of this chapter. Okay. Here, capital maintenance. Capital refers to the net asset of a business. Since the business uses its asset for its operations, a fall in net asset will usually mean a fall in its activity level. It is therefore important for any business to maintain its net asset in such a way that as to ensure that the continued operation at least at the same level year after year. And in other words, the individual should not exceed profit after appropriate provision for the replacement of the asset consumed in the operation. For this reason, the Companies Act does not permit distribution of dividend without providing for depreciation on property, plant and equipment. Unfortunately, this may not be enough in case of rising prices. The point is explained below is equal to, we have already observed that P is equal to CA minus CL minus opening asset minus opening liability minus capital introduced plus those drawings. Then capital or dividend. So profit P is equal to opening assets OA minus opening liabilities, opening asset and opening liabilities OEL and closing assets current closing asset and closing liabilities CL. So asset is C and closing liability CL and opening asset is OA and opening liability OA. And introduction of property is C and drawing dividend is equal to T and return profit is this way. And the business should ensure that the return profit is not negative, so that the closing equity should not be less than the capital to be maintained, which is the sum of opening equity and capital introduced. It it should be clear from the above that the value of the return profit depends on the valuation of assets and liability in order to check maintenance of the capital, so that whether or not return profit is negative, we can use any of the following three bases. One is financial capital maintenance at historical cost and financial capital maintenance at a current purchasing power. So now first, under this convention, opening and closing assets are stated at the respective historical cost to ascertain the opening and closing equity. If return profit is greater or equal to zero, then the capital is said to be maintained at a historical cost, and this means the business will have enough funds to replace assets at historical cost. This is quite right as long as the prices do not rise. But in financial capital maintenance at current purchasing power, under this convention, the opening and closing equity at historical cost are listed at the closing price using the average price indices. Then, for example, suppose the opening equity at a historical cost of rupees 3 lakh and opening price index is 100, and then the opening equity at the closing price is rupees 3 lakh 60,000. If the closing price index is 120, by considering the inflation and a positive return profit by this method means the business has enough funds to replace its assets at an average closing price, and this may have served the purpose of because prices of all assets do not change at the average rate in a real situation. For example, price of machines can increase by 30%, while the average increase by 20%. This may not serve the purpose because the prices of all assets do not change at the average rate in a real situation. For example, price of machine can increase by 30% while the average increase is 20%. Okay. Now, physical capital maintenance at a current cost. Under this convention, the historical cost of opening and closing assets are restricted at the closing prices using specific pricing indexes. Those applicable to each asset. The liabilities these are also restated at the value of the economic resources to be sacrificed to settle the obligation at the current date, such that the closing date, the opening and closing equity at the closing current cost are obtained as an excess of aggregate current cost values of the asset over aggregate of current and cost values and of liability. A positive return profit by this method ensures retention of funds and replacement of each assets at the respective closing prices. We'll summarize the components of the financial statement of balance sheet, statement of profit and loss statement, cash flow statement, notes, and other explanatory materials forming part of the financial statement. And what balance sheet do? It's what are the values of economic resources controlled by an enterprise. Statement of profit and loss present the result of the operations of an enterprise. Cash flow statement shows the ways an enterprise generates cash and uses it. And notes represent the supplementary information explaining the different items. Users of financial statement, investor, employees, suppliers and creditors, customers, governments, lenders, and public. Investor for analysis the performance, profitability, and financial position of a company. Employees knowledge of stability and continuity and growth of the company. Suppliers for its creditworthiness. Customer for the analysis of stability and profitability. And government for the evaluation of Entities' performance contribution to the social objective and for tax determination. Lenders to determine whether their loans and their interest attaching to them will be paid when due, and public determination of contribution to the local economy and public at large. Fundamental accounting assumption, accrual, going concern, and consistency. Accrual, the transactions are recognized as they occur without considering as and when they occur without considering receipt and payment of cash. An enterprise will continue its operation in foreseeable future and will not liquidate. Consistency, using the same accounting policy for similar transactions in all accounting periods. Understandability, relevance, reliability, comparability. These are the qualitative characteristics of financial statement. A qualitative characteristic has been divided into two fundamental qualitative characteristics and enhancing qualitative characteristics. We are seeing understandability, relevance, reliability, and comparability. Understandability in the information represented in the financial statement should be readily understandable by the users with the reasonable knowledge of the business and the economic activity. Financial statement should contain the relevant information. Only information which is likely to influence the economic decision of the users is called the relevant. Whether information must be reliable, that is to say they must be free from the material error or biases. Comparability, financial statements should provide both inter-firm and intra-firm comparisons. Then we will see the elements of the we have seen the elements of the financial statement, whether assets, liability, equity, income or gain or expense or loss. And, and summarize the asset as the resources controlled by the enterprise as a result of the past event from which the future economic benefits are explicitly told to the enterprises, whereas the present liability is the present obligation of the enterprise arising from the past event and the settlement of fees is expected to the result in an outflow of the resource embodying the economic benefit. Then equity. Equity is a residual interest in the asset of an enterprise after deducting all its liability. Income. Income incurs the economic benefits during the accounting period in the form of inflows or in enhancement of the assets or decrease in the liability that result in the increase in the equity other than and those relating to the contribution from equity participants. Then expenses is the decrease in the economic benefit during the accounting period in the form of outflows or a depletion of the assets or incurrence of the liability that result in the decrease in the equity, other than those relating to the distributions to equity participants. Then we have seen the measurement of the elements by historical cost, current cost, and the realizable or settlement value and the present value. In the historical cost is the acquisition price, where the current cost and assets are carried at the amount of cash or cash equivalent that would have been to be paid if the same equivalent asset is acquired currently. If you have to acquire it currently, then what resources we need to give up? That is the current cost. Liabilities are the carried out the undiscounted amount of cash or cash equivalent that would be required to settle the obligation currently. If you have to settle the obligation currently, what will be the cost? That would be the current cost. Realizable value for asset which amount currently realizable on a sale of an asset in an orderly disposal for liabilities. This is the undiscounted amount expected to be paid on the settlement of the liability or in the normal course of business. Then present value assets are carried at the present value of the future net cash flows generated by the concern assets in the normal course of business, and the liabilities are carried at the present value of the future net cash flows that they expected to be required to settle the liability in the normal course of the business. So net realizable right now, if you have to discount and you have to sell the asset or settle the if the asset the currency realized on the sale of as orderly disposal. It is the amount currently realizable on the sale of it's a real when we sell the asset for how much amount will realize, that is the realizable or settlement value, and current is for acquisition, current cost for acquisition of asset currently, and settlement of liability currently. But if when we set realizable or settlement, if we have to realize the asset, whichever the cost will obtain is not realizable value. And if you are to settle the liability, undiscounted amount expect to be paid on the settlement of liability in the normal course of the business is called the realizable value. And we are learn about the present value. So present value is the asset value of the you have to use time value of money for calculating present value of the assets and liability. Now we have seen the financial capital maintenance at a historical cost. The opening and closing assets are stated at the historical cost. At current purchasing power, restatement at the closing prices using the average price indices, and physical capital maintenance is the restatement of at a closing price using the specific price indices. Here, now we will see the going concern is the business can continue its as a, the going concern assumes that the business can continue to operate again for the foreseeable future. Again, and this is not continuing to this is the answer. Two principal qualitative characteristics, the fundamental that we have the reliance and reliability is the what we can say as a quality principal qualitative character of financial statement. Then all the following are the components of the financial statement: balance sheet, plus uh, human resource. All of the following are the components except balance sheet is the this and human and social responsibility. Human responsibility is not this not. Wow, these are not. Uh, the social responsibility CSR report to be provided and so that human resource. Yes. Yes, we can say session CSR report. Then accompanying and accounting policy can be changed if the changes required by statute and a more appropriate compliance statute, as well as statute as well accounting standard, both A and B. So statute, more appropriate representation. So both A and B. The value of equity may change contribution to income and expense all of them. So we don't cover periodical one. So ABC, AB double CD. B, B, double C, G. Okay. Now we'll conclude the second chapter of advanced accounting, that is the framework for preparation and presentation of financial statement. Now we will start within half an hour, 1 hour. We will start the third chapter of advanced accounting, that is applicability of accounting standards. Thank you.